Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoy. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. Here we are. It's Friday, and we're together, and we've got our listeners out there. And we've got a couple of questions.
Our first question comes from Chris. Hi, Jim. Please ask Bob to consider commenting on the recent spikes in energy. I read that European natural gas prices are equal to $190 per barrel oil. I've always viewed that eventually the cure for high prices is high prices. Are we at an interim peak in energy, or has society environmental, social, and governance criteria their way to a supply pickle that'll be around for a while? Thank you. Chris from Rhode Island.
Yeah, Chris, thanks for your question. It's got some facets to it. The costs of energy in Europe and in England are gone up huge because governments there have been very ambitious in ending uninterruptible power, coal, natural gas, and quitting or ending that source of power faster than they can bring on the unicorn power with, windmills and solar cells and that sort of stuff. So it's a major policy blunder, and this winter, folks in England and Northern Europe are going to be hit very hard enough perhaps to begin a popular uprising that can act against it. So here this gets at, is this an interim peak in energy prices? But what we were looking at for this year is, back in January, that commodities would generally be pretty good right out to around mid-year. That was based on seasonality for, say, copper with a secondary rally out to July, or lumber with a rally into June. But as it turned out, there was a set of very hot moves there. Copper, certainly lumber, and the grains, soybeans and corn went up and set technical highs. And then they kind of backed off. And then it was the first of September when my colleague Ross noted, he says, this thing could set up rotation where you can get another set of commodities going straight up, and these have been the energy related. They're nat gas, crude oil, lithium as part of the crazy speculation, coal, steel of all things. Aluminum is another one that's going straight up. But it's interesting that, for example, iron ore, it set its high in May and has packed it in completely. So we're looking... Oh, now one other thing is the seasonality on crude. Years ago, we used to have a pretty good seasonal model on crude oil, and often it could set a high in late September or early October. So again, going back to early September, I brought that forth in the piece I write and said, I wonder if we could go back to the old seasonal where you'd have a good high for crude at about this time, which we're getting. So it's been a rotation from earlier in the year, lumber and corn, for example, and then now a set of energy items with a couple of exotics like lithium in it, and then plus, for all reasons, I don't know why, but aluminum. So this, I don't think, is launching what many are calling as a return to the 1970s inflation. I think it's the rise in commodity prices that you get with the business boom side of the final stages of a great bubble in financial assets. And within this, there's, Chris, a couple of kind of sophisticated items, and you do the real price of copper deflated by the consumer price index. And at the conclusion of great financial bubbles, copper's real price has gone up, and it has. Then, ironically, going the other way, gold's real price, deflated, has gone down. And here's one of the ironies for all those calling for inflation out there. If it's so, why are the gold stocks not flying? It's not happening. So then, and then another key item is that real long interest rates decline in the final phase of a great bubble, and those for the long-dated U.S. Treasuries got down on the latest posting, I think it was -3. At previous bubbles in the past, like 1825, a minus real has occurred before. And then, so what you've got, then the fourth one is that the dollar index has set a base that lasted for 6 months and then completed the base and then now is more or less breaking out. So it looks more like 1929 than it does of 1970. So your question is very critical, and the answer is that the dominant feature is the financial mania. And the rise in commodities is with the business strength that you get with the final stage of the financial mania. So, and this, I think, is beginning to change. Credit spreads are no longer narrowing, and the number of commodities that have had speculative spikes and broken down, that's in the history books. So I think this latest action in natural gas, as a matter of fact, this week the action in natural gas gave us technical excesses with upside exhaustion, which is a momentum-based indicator, and then also it's given a sequential sell, which is a pattern-based indicator. So, very timely question, Chris, and this recent action is a rotation into energies, and it's very close to completing.
A question from George. Bob, one of the most frustrating things about following the markets is trying to discern which analysts are going to be accurate. They basically have similar data sets, all claim to have a track record. Very smart analysts such as Kathy Wood, Jim Records, Howard Marks, Nouriel Roubini, Jeffrey Gundlach are very divided over the inflation or deflation debate. Michael Oliver, Bob Moriarty, and others see gold prices rising significantly. On the other hand, Tom McClellan says gold has entered into a 5-year bear market and prices will not rise until 2025. Oil will be the play as it replaces gold. Radomonsky has a similar forecast. Where do you fit among this group? How does the little guy know who to believe? Your friend George.
That's a good summary. It is very difficult, and if I didn't have the financial history, it would be tough figuring out what's going on. Now, you mentioned Jim Rickards. I followed him because he's the one who touts that he used to be with the CIA or something like that. And, of course, the CIA can't get anything right. And I'm going to take a little shot at Rickards because I've found that whenever you get about a 5 to 10% rally in gold, he comes up with the forecast of 5,000. And then if you get, say, a 15% rally in gold, and then his estimate goes to 20,000. So that's just a little side amusement. again, will follow with what we were saying in response to the last question, but mainly dwell on gold here. And the action in gold through each financial bubble, of which this is number 6, has been reasonably quite consistent because, and again, there were times in the senior currency when gold price was fixed, and there are times when it hasn't been, but you net that all out by deflating the gold price by the consumer price index. And that pattern has been consistent, whereby gold's real price goes down with the final phase of the financial mania. And in this one, gold's real price peaked in 2011, and it declined until this year, and you can say that it hasn't quite made the turn to up yet, but we certainly got the decline with the financial mania. So where this interacts with gold stocks is that when the real price is going down, it reflects that profit margins are not so good. So in the boom of a financial bubble, the costs of energy go up, the cost of wages go up, and the cost of mining goes up. So gold miners don't make so much money. And this was the case in 1929 with Homestake, when it was the premier producer, and their stocks, of course, went up a little with the financial mania in 1929, and then got hit in the crash down to $8 and change. And their earnings were not so good for 1929 because their costs had gone up, but the price of gold stayed at $20.67 an ounce. So poor earnings report. And then with the 1929-1930s crash, the real price of gold went up, and so that you want to take Homestake to the end of 1932. It wasn't until March 1933 that Roosevelt started fiddling with the price of gold. But by the end of 1932, Homestake's earnings had improved by something like 140%. I used to have the memo in front of me here, and their stock was up in that order as well. When late 1932, the S&P was still having severe problems. So, and the main thing I want to get across there was no change in the price of gold, but the real price went up. So this is where on each post-bubble contraction, the price of gold's real price has gone up, and that blesses the industry with improving profit margins when everybody else, copper miners, lead miners, industry, railroads, and all that thing are suffering a post-bubble contraction. So it's the only group that you can analyze ahead of time that can be expected to perform well in a post-bubble deflation. So I think it's going to be the case here. So on our work for this year, I guess since June, we've been looking for the decline in gold stocks, GDXJ, to continue until around November. And that November target was based upon the probability of the financial markets in New York discovering another credit crisis, which looks like it's getting close. But at any rate, independent of that, our indicators are not yet signaling a buy in the gold stocks, which I'm quite confident we will get when the time arrives. And the point in being in gold stocks on the next rally is that quite likely the gold stocks will outperform the S&P. And then if that goes on for a few years, then you know that many portfolio managers who may not usually include gold stocks in their positions But if you got a sector that's consistently outperforming the S&P, then the non-gold people will have to get in the action. So you can see we're looking for a huge bull market for gold stocks following the next buy, and that next buy is going to be very critical. And thanks for the question.
We'll have more with Bob Hoy right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoy. Some of the headlines that caught Bob's attention today. China steps up efforts to contain Evergrande, not to save it.
Yeah, boy, that's a dandy. I remember with the Asian crisis in 1997, that was a while ago now, but it started on July 1st with a problem in Thailand, and their currency got whacked. Their central bank had run out of reserves, and so they had a crisis. And the media immediately said, "Oh well, it's a local problem; it won't spread." A few weeks later, it hit the Philippines, and then the next set of headlines was, "Oh, it could be contained." So this is one of those they've obviously China's given up on trying to save Evergrande, but they think that the disaster can be contained, and that's not the case. So this then, these kind of financial problems, when they appear in outlying exchanges, they can eventually work their way into the senior financial exchanges such as New York and London. And to me, in watching things, we're on that path. So the next few months are going to be very interesting.
Another headline, empty buildings in China's provincial cities testified to the evergreen crisis. And friend of the show, Danielle Park, pointed out to us that there's 190 million empty properties in China right now.
Oh, I didn't see that number. So let's call it 190 million empty condos or empty flats or empty residences.
Exactly.
Whoa. Yeah. Well, because in after the 1873 bubble and collapse, which the railroad stocks were very popular on that one amongst investors and promoters, and the great financial guy at the time, Vanderbilt, said that there was no business in building railroads from nowhere to nowhere, and that was the case then in the 1870s. And here we are now. These guys have built not only railroads and roads from nowhere to nowhere, but at each end of a road or a railroad, there's a whole lot of empty apartments. It's astounding. And it's going to be fascinating to watch and see how it all falls out. Yeah, that's a good term, Jim. Falls out, yeah.
And China's population is no longer growing. It's going to start to shrink thanks to their one-child policy. And Chinese officials themselves admit this could lead to a future labor shortage.
Yeah, I guess you get the demographics, but who's the great Elliott Wave guy?
Elliott?
Yeah, no, Elliott Wave guy. Anyways, I'll think of it. But he did a study on demographics in the 1929 boom and whatnot. And that was in 1970 when that mania was propelled by everybody was turning 50, so they had to buy the stock market. So they were using demographics to push the stock market up. And then with the Elliott Wave guy, he did the definitive study on 1929 and pointed out that the crash in the post-1929 affected the demographics. People were slower getting married and slower having kids and everything else. So there are times when the financial markets get hit demographics, and the argument back in 2000 that demographics would continue to rise the stock market up really didn't work. So I'm always doubtful of demographic studies.
The U.S. Bond market, high-grade bonds, $100 billion worth sold in the past month. What does that tell us?
Oh, they've been doing record treasuries and also record high-grade bond sales. And here's another one, record junk bond sales. Oh, yeah, here's the one. Their record junk bond sales, they're placing the bonds at, well, of course, a much higher yield than treasuries in order to pay dividends. So their equation is that they can get cheap money, although it's relatively expensive money, from selling junk bonds, and then they're taking borrowed money to pay the shareholders' dividends. I think it's crazy. So we'll see how that one goes.
Bob, thank you so much for being on the show.
Jim, good to be with you, and we'll look forward to next Friday.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Bob loves to answer your questions. You can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.